lenders are most concerned with the level of EBITDA add-backs and synergies not materializing. So much of their portfolio growth in this cycle has been driven by these add-on acquisitions. And instead of deleveraging, issuer leverage is creeping up post-close.
Fran, can you find hard data somewhere to corroborate what lenders are saying?
Well, we can look to the BDCs as our easiest barometer of direct lending financial health, and there has been some stress surfacing there as managers have been stretching for yield. BDC portfolio non-accrual rates are showing a modest quarterly uptick. They're at about 3% right now, which isn't too bad, but that's the highest level we've seen since 4Q16.
Okay, so let's turn to our favorite issue.
Why New York sports teams are so terrible?
Well, there is that. No, I meant EBITDA add-backs.
Yeah, so Standard & Poor's has some really good data on that. They're showing that the average EBITDA miss versus budget for the last several years has kind of been in that 30 to 35% range. That means leverage ends up being in the 6 to 7 times area a few years out when it should be in the 4 times area.
Those are scary numbers, kind of like the 7 and 21 NICs. So what other statistics do you track?
Well, in BDC land, we tracked over 60 new issuers that were in default this past quarter. And Lincoln International also has a very similar stat that each quarter on average, about 12% of issuers they value hit a leverage covenant breach out of a universe of about 500 names.
Do you see this reflected in worse credit ratings?
Well, Randy, just look at the rating universe, right? Over 63% of rated issuers are B2 or lower. This really makes the market more susceptible to economic weakness and downgrades. We saw like 5 months of downgrades in the second half of this year. In fact, the downgrade to upgrade ratio in 3Q19 hit the highest level since 2015.
Whoa, how does that compare to last year?
Well, in 2018, Moody's had 1 sector on negative outlook. That rose to 9 sectors this year. So industries such as manufacturing, chemicals, coal, paper and forest products, steel, telecom, auto parts, and railroads.
Whoa, Fran, all those cyclicals are making me dizzy. But isn't there better news now on the economy?
Yeah, we've had some positive news in the last few weeks, which is great, but I'm still not sure how much it changes fundamental economic performance for lenders' portfolios. We're going to have to really wait and see.
So what about direct lending? What other big themes are you expecting to emerge next year?
Well, we expect the megatranche trend to continue, which is basically unitranches for large corporate issuers over the $500 million deal size. At Refinitiv, we tracked about 17 this year. We do think that middle market deal flow is going to be constrained relative to the demand. So what this means is those lenders with the big holds, they're going to continue going up market.
Megatranche. Ooh, I like that. Will we finally see the first $2 billion uni?
I think that definitely could happen. Direct lenders are going to continue to take share from the syndicated market, and fundraising is expected to stay robust, and LPs are going to continue allocating to private credit.
So how much fundraising for direct lending do you think we'll see?
We're estimating about $65 billion next year. Now, that's below the 2018 peak of $100 billion, but it's very similar to the levels we saw this year. Randy, another big theme to watch is lender consolidation, particularly in the BDC landscape. So there's already been 8 transformative BDC announcements this year, where one manager acquired another that was struggling, or where a platform announced they were seeking strategic alternatives. I really can't remember any other years where we've had so many announcements, so we expect this trend to continue in 2020.
So investors should continue to put direct lending high on their shopping list, right?
Yeah, I mean, from a risk-return perspective, middle market loans are still pretty attractive, and negative interest rates still persist globally. There aren't a lot of better alternatives, but LPs are getting smarter and wiser, and they know what to look for in terms of experienced managers.
That's great, Fran. Anything else before we wrap up?
Well, Randy, since I like to interview folks too, I think it's my turn to grill you.
Okay.
What are your big predictions for next year, and what are you most concerned about?
Well, every year I predicted a recession is 18 months away, so much for my predictions. I am much less worried about a recession now, which means, of course, we're going to have one starting in March. I do think some kind of correction would be welcome, even if it's based on market technicals, just to keep direct lenders in their lanes. Otherwise, the stupid stuff is going to get stupider. you know what the leveraged loan mantra is, right? Anything worth doing is worth overdoing. So that's all for now. This is Randy Schwimmer
and Fran Beyers.
We'll see you next time on the Fran and Rand Show.